Okay. So again, I'll try to revise back the previous concepts. So yesterday we have started discussing about equity bonds and what kind of returns we'll get. What is the risk exposure for each type of fund, like equity fund, what kind of risk we have, and returns how we would get. What is the ownership dilution with the examples as well we have seen. And also we spoke about dividend, how the dividend will be distributed. What is the purpose of having a dividend to the shareholders? And what kind of return will be receiving by the bond holder? Why we have to call them as a bond holders? And also how the interest is going to be expensed to the company. And we spoke about bond valuation as well. It's basically the present value of future cash flows. That's so these are all the topics that we discussed in the previous class. So I hope is everyone good with these concepts, right?
Yes, Mahesh.
Yes.
Yes, sir. Sure.
Main purpose of calculating this bond valuation is to know the yield to maturity. We call it YTM, yield to maturity. Yield to maturity is nothing but, suppose if I'm investing in a bond, let's take for the same example. Every year we will be receiving 30 rupees interest, and on fifth year we will receive 30% interest as well as the principal amount, right? And at the time of fifth year, suppose if you want to sell the bond, maybe the bond value will be a bit higher also. Like suppose maybe at realization, we will realize at face value 1,000 rupees. But if you want to sell the bond to someone else after 4 years or something, there will be a gain as well on the bond price as well, right? Suppose I might purchase the bond for 1,000 rupees. But if I want to sell this bond in the market, I can sell it for 1,200 rupees also. There will be appreciation of price of the bond as well. There will be a possibility, right? Similarly, like
That's
how
what.
share prices are increasing. I'll purchase it for 100 rupees. It may increase up to 200 rupees or 130 rupees. Like that, bond price will also may increase or may decrease. So with this yield to maturity concept, what we are going to calculate is what is yield to maturity. Basically, the yield to maturity is it's a comprising of two elements. One is the interest element, which is nothing but return. Interest part plus the gain. Gain. Yield to maturity is the gain. So what is return? Already we discussed about return. Return is nothing but interest. We'll be receiving fixed rate of interest, right? That is called return. And also we will receive some gains, or else the principal amount of bond even we can realize the face value, whatever the amount we have, that would realize at the time of maturity. So all together we call it as yield to maturity. Yield to maturity is a comprising of bond price plus the returns, the total return that is anticipated on the bond. Suppose if we are holding this bond for until end of its lifetime, suppose the bond is for 10 years. Up to 10 years, if you are holding this bond, till 10th year, you will be receiving interest, and 10th year, you will get face value as well, right? So all together we call it as yield to maturity. Okay. So if you want to calculate this yield to maturity or bond valuation, we need few parameters. I mean the elements. We'll talk about those. First one is coupon rate. What is coupon rate? We didn't discuss. We spoke about interest rates, interest amount, return. What is this coupon rate? Coupon rate is nothing but an interest rate only. We normally in a layman terms you can say it as an interest rate, but in terms of bond market we call it as coupon rate. Coupon rate is nothing but an interest part. Okay, coupon rate, interest part, both are same. So this coupon rate will be determined in different ways. Suppose if I'm saying like a 3% semi-annually. What? Semi-annually. That means semi-annually for 6 months once I'm paying 3% interest. If I say 3% per annum, if I pay 3% per annum, that means per annum I'll pay 3%. And also the interest payment may also be different. The interest payment can be a semi-annually, quarterly, monthly, or even it can be yearly also. There will be interest payment also, payment period, or we can say payment frequency or payment period. So payment period can be, it can be monthly or quarterly, semi-annually or annually. It can be anything. The payment period. Suppose the coupon rate is 3% per annum. 3% per annum. If the interest payment is semi-annually, for 6 months once we are paying interest. For how many months are we getting the interest? For 6 months. What is the interest rate per annum?
3%.
3%.
3%. Let's assume bond face value. Bond price is 10,000 rupees. Now tell me how much interest I'll get in a 6 months?
1,500.
600.
So basically, if you
600.
want to calculate the coupon, we are considering the bond price into coupon, the coupon percentage. We have right, the coupon amount. This for
300.
1 year. This for 1 year. I need to get it for 6 months. So what I'll do? Again, this interest amount divided by 2, or we can say into 6 by 12 also we can do. So this 3% is a semi-interest annual interest. So I need to convert that annual interest into 6 months once. That's why I'm dividing the total interest by number of period. So for 1 year, how many times I'll be receiving this interest?
For 1 year, 2 times. 6 months once.
2 times. If interest payment period, the period of the frequency will be twice in a year. Suppose if it is quarterly, I'll be receiving for 4 times.
4 times.
If it is monthly,
Yes,
I'll be
12
receiving
times.
it for
12.
12
12
times.
months. But in most of the cases, and almost in all cases, the interest amount will be specified in per annum only. Interest amount will be specified in per annum only. But we need to convert this interest rate, or it can be interest amount as per our interest period. It can be monthly, quarterly, or semi-annual.
Annually.
Okay, that is all about coupon rate. Okay.
Okay, sir.
Then we have a maturity date. Maturity date. What is maturity date? Every bond will have a maturity. Without bond, there won't be maturity. Without maturity date, there won't be bonds. Just understand this topic in this way only. Again, we are going to talk about types of bonds. There are few types of bonds where there is no maturity date even. So we'll talk about it even later. But as of now, we need to remember that as a bond, definitely there will be a maturity date. It can be a 10 years once or 5 years, 20 years, there will be maturity. So what will happen on maturity? The issuer, whoever issued the bond, it can be corporate, it can be government, RBI, whoever issued the bond, the issuer repays the investor, the full face value of the bond, whatever the face value we have, the full amount we need to repay it to the investor.
Repaid to the investor.
Basically, the issuer is nothing but the person who selling the bond. Initially in the IPO or secondary market, who sold the bond, we call it as issuer of the company. So the issuer of the bond has to pay this amount to the bondholder on maturity. That is called maturity date. Every bond will have a maturity date. And we have a current price or current market price. We can say anything. So already yesterday we spoke, in the secondary market somewhere we spoke, right? What is the face value and what is the market price? Do you guys remember? Are you guys remembering?
Yes, Mahesh. Yes, Mahesh.
So what is face value?
Face value when the share price will be determined in the first time, that is face value. Current price means whatever the market price will be there, that is the market price.
Yes. Face value is nothing but just for the recording purposes. It's like a par value. We call it as par value. Even I had to discuss about this as well. So the par value is nothing but where we will establish one value for the first time issuing for the public, just for the valuation purpose or maybe for the determination purpose, we will determine the face value. It will be a fixed amount for the whatever we have a price we are determining the face value, that will be fixed. It does not change throughout the lifetime of the period. Suppose the bond is going to be issued for 10 years or 20 years. Throughout this 10 years or 20 years, the face value won't change. It is the same value. Even we will realize the face value only. If you are holding this bond until maturity, you will realize only the face value. And also until maturity, you will be receiving the interest payments. That is the concept of bond. So here we have like two types of issuing. Normally yesterday itself we had to discuss about this one. Issue type, issue prices. Suppose there is a face value. There is a face value. It can be bond, equity, share, whatever it is. Let's assume face value of share is 10 rupees. Face value of share is 10 rupees.
10 rupees.
If I'm selling this share for sale price of 12 rupees, there will be chances where I can sell it for 8 rupees also, right? Where I can sell it for 7 rupees also. There would be chances, right?
Yes,
Yes.
sir.
So what does this mean? If I'm selling this face value 10 rupees, the same face value, if I'm selling it to the public, that is called at par value. That means whatever the face value we have, for the same price, I'm issuing it to the public. I'm selling it to the public. That is called at par issue.
Okay.
Par is nothing but same value. At par means same value, equivalent to face value. The sale price, the market price, and face value both are same in case of at par. In this 12 rupees, if I'm selling this for 12 rupees, I'm collecting some extra amount, right?
Yes, sir.
How much extra I'm
Yes, sir.
collecting?
2 rupees.
2 rupees extra rupees. amount.
So 2 rupees extra I'm collecting. But in case of sale price 7, the actual
3
face
rupees
value
loss.
is face. No, we can't
3
call it as a
rupees
loss.
less.
Let me explain it. So actual face value is 10 rupees, but I'm
Yes,
selling it
sir.
only for 7 rupees. So 3 rupees, what I'm doing here?
At a discount.
Keep it.
We are giving a discount, right? If
Yes,
product
sir.
value is 100 rupees, but we are selling it for only 90 rupees, you are giving 10% discount. Here also, if sale value is, the issue price or sale price is less than the face value, we call it as discount. We call it as discount. Similarly, if you are selling for more than face value, that's we call it as premium. Okay. So if I'm issuing at the same price, we call it as at par. So if it is at premium, we should call it as at premium. If I'm giving the share at discount, we call it as
At a discount.
at discount. In most of the cases, shares, bonds, everything will be at premium. Okay. So now let's come back to the concept market price. Even in bonds also, there will be chances to have a more market price. It will be more than the face value. So if you want to sell the product, if you want to sell this bond in the open market, you can sell it at current market price. Depending on the level of interest rates in the environment, the market and the economy, the investor may purchase the bond at par. Sometimes it will purchase at discount. They will purchase at premium. Different cases will be there. But always the current market price. Suppose if it is a share, easily we can say like several factors will influence the market price, right? The economic, also the inflations, company market situations, the investments, the key managerial persons, and also their corporate actions. All these factors will impact the current market price, isn't it? Similarly, the current price of a bond also will be impacted by several reasons. But majorly, as it is a bond, and the main return is all about the interest, coupon amount, interest payments, right? So in majority of the cases, the bond interest, the bond prices will always be influenced by the interest rates. Bond prices always will be influenced by the interest rates. The volatility in the bond prices changing, and there will be volatility because of the interest rates. What is in this interest rates? Yesterday we spoke like interest rates will be fixed, right? Again, we are saying like based on the interest rate, there will be a bond price. At the time of purchasing itself, we will be knowing, right, how much interest rate we will be getting. Then what is this interest rate again? Which interest rate will impact the bond prices?
RBI imposed the interest on banks.
Understand, guys? So interest rates of a market. Suppose if you are purchasing a bond at 3% interest, it doesn't mean that every company will issue the same percentage of interest to every bond.
No, sir.
No, sir.
Do you think
No.
that corporates and governments will issue all bonds with the same rate of interest? No, right? Each bond may have different interest rates. So it depends on their interest rate also, our bond price will will impact. Still, we are not getting, so some confusion is there. Let me understand this concept in different way. Suppose I am running a company, okay, Meta Aspect. Okay, I'm issuing a bond. I'm issuing issuing bond. So face value of bond is 100 rupees. Face value of bond is
100.
how much?
100
rupees.
100 rupees.
The interest rate is, let me write it here itself, at 3%. At 3%. Okay. Now there is another company which is a competitor for me or something. There is another company, XYZ company. Okay. They are also issuing a bond. They are also issuing bond. They are issuing the same face value.
But interest rate is
ఏమంది దీనికి? One second. ఇది ఆపోజిట్ లో చూపిస్తాను మనకి. Okay. It's not working. Anyone have any idea? Even I turned on my caps lock, still showing caps letters. Fine. So the face value, the same 100 rupees, but they are giving interest rate at 5%. How much?
5%.
5%. So normally as a people, as an investor, which bond we will purchase? One company is
XYZ.
paying 3%
XYZ.
interest. Some other company is paying 5% interest. Obviously, people will prefer to purchase XYZ company bond only, right? Because they're paying 5%
That
interest,
bonds.
which is more than my company interest rate. They're paying more. So definitely people will prefer to purchase this bond. But still, I have to sell my bond. Is there any possibility to sell my bond? I have to sell my bond. It doesn't mean that I cannot change my interest rate. I cannot ask someone else to reduce their interest rates. I cannot demand XYZ company to reduce the demand, I mean the interest rate prices, right? It's their bond and their interest rate. So I cannot demand them. I cannot request them. So I have to do something to sell my bond. So how can I sell my bond?
Will increase the interest rates.
We cannot increase. It's a fixed. Let me understand in different way. Again, the same example. Guys, 1 second. So we have a product, like 2 products. Same, let's take a water bottle or something. Okay. Someone is selling the same water bottle with the high quality. Someone is selling the same water bottle with a less quality. Definitely people will observe the quality and will prefer to purchase the high quality product. If the price is same. If the price is same, right? Still,
Yes,
if you want to sell the same product along with high quality products, though your product is very less quality, still you have to sell it. How you will sell it now?
Discount.
Increase and discount.
Discount.
Yeah, we have to sell it at discount only, right? Then only we can sell we can make the sales.
Yes.
If product is same, but quality is different. So we have to reduce our price. Similarly, here also, I cannot change interest rate. It's a 3% fixed. They are also not going to change the interest rate. It's a 5% fixed. But I have to sell my bond. How can I sell it?
Reduce face value.
I-
Reduce the
I
face
can
value.
sell my bond with discount, right?
Yes.
So I can make it somewhere like 90 rupees. I can sell it for a sale price 90 rupees. Then maybe people will prefer to purchase this bond because maybe the interest rate is less, but people are, I mean, they can purchase it only for 90 rupees. But the beauty of this bond is you can purchase at any price. It can be at par, at premium, at discount, whatever the price it is. But on maturity, you will get 100 rupees. You will get 100 rupees. The face value you will get. On maturity, face value we will realize. As a bond holder, we will get the face value back. But while purchasing, you may have to spend extra amount at premium. You can get it at discount also with a discount. So now, from the company perspective, if they want to sell this bond, they have to go for discount. So they're selling it for only 90 rupees. So investor will decide like this. Maybe I'll be receiving in less interest. But to compensate that, what I'm getting the extra benefit.
10 rupees extra.
10 rupees.
10 rupees discount I'm getting. But I'm investing only 90 rupees, but at maturity I'll get 100 rupees, right? So here I'll get 10
Yes.
rupees profit, and every year I'll be receiving 3% interest also. Like that, I'll try to match the performance between these two bonds. Then I'll prefer to purchase. But trying to understand if the market rates are more or bond price reduced or increased.
Increase.
Increased.
What is your market price are?
Market interest rate is more
Uh,
increasing, or bond price reduced or increased.
Reduce.
Reduced.
Reduced. We're all good, right? We're all good with this concept, right?
yes.
Because
Yes.
of
So,
higher interest rates in the markets, there is a reduction in, there is a reducing of our bond price. High interest rate causing reducing the price of a bond. Correct or not?
yes, sir.
Suppose, let's give it as in different way. There is another company, ABC, maybe after maybe 1 or 2 years, the same XYZ company issuing another bond. Okay. This time they are issuing face value same 100 rupees, but they are issuing at 2%. How much?
2%.
2%. Same again, I'll be issuing from the Meta-Aspire also I'll be issuing, but the interest rate is 6%. This time bond investors will prefer to purchase which company bond? XYZ company or Meta-Aspire?
Meta-Aspire.
Why? We are paying more interest.
Interest rate is more.
Suppose every company throughout the market, every company is offering 2%, 1%, 2% like that, but I'm offering 6%. Is this good for my company?
No.
No.
No, sir. No, sir.
No, right. Obviously, people will prefer to purchase my bond only. But what should I do to pay this 6% interest? I have to cut down that interest, but it's not possible for me to cut down the interest. So what I have to do?
Discount.
Discount. Already you are giving 6% discount. Again, you're giving a discount. Again, face value, you are going to pay the face value. You will get a more loss, madam.
Sir, premium this.
This bond is 100 rupees. This bond is also 100 rupees. These guys are paying 2 rupees interest, but I'll be paying 6%. If I'm paying more interest, why should I sell it for 100 rupees?
Sir, ఇక్కడ face
We can
value
increase
ఉంది.
the face value.
Face
Face
value
value we
100
cannot
ఉంది కదా sir.
Face value we cannot increase. The issuing value,
ఇప్పుడు
the selling price we can increase.
Selling price.
So I can
Premium.
increase, right? Definitely. Because
Yes.
my security is paying more interest. If you want it, purchase it with a extra price. Getting the point?
Yes, Mahesh.
Yes, sir. Yes,
Yes.
sir.
Maybe I'll sell it for 110 rupees. Or maybe 120 rupees also. Now you are paying extra. When you compare with the remaining markets and the remaining companies, you're paying extra 120 rupees extra you're paying. But for that, you'll get extra interest also, right?
Yes, Mahesh.
So in this case, because of reducing interest rates in the market, my bond price increased or reduced?
Increase.
Increased. So what is the relation between these interest rates and market prices? Now tell me.
When one 10 price was increasing, another one should be decreased.
Come again?
Interest rate is more than you have discount. Interest rate is less, you have increased the price, sales price.
So basically, the interest rate and market prices always will have an inverse relationship. Inverse means opposite relation. Suppose if interest rate is increasing, bond prices will reduce. If interest rates are reducing, bond price will increase. Okay. Again, don't compare between price to price or bond interest to interest. Interest and price, between the bond interest rates and bond prices, there will be always inverse relationship, opposite relationship. Okay, understood now? This is
Yes,
most
Mahesh.
important concept in the bond market. You guys have to remember this. Okay.
Yes, Mahesh.
So that's the reason the current market price will be bit different. It can be more also sometimes. Okay. And we spoke of these are the parameters normally we will use to calculate the coupon rate, yield to maturity, and the bond valuation. Okay. Now everyone good with this?
Yes.
Sir.
Now tell me any doubts on this?
No, sir.
Oh. Now you understood this concept, right? Relationship between interest and market prices.
Yes, Mahesh. Yes, sir.
Yeah.
Yes.
Okay.
Yes.
Now we will see types of bonds. Types of bonds. Can anyone name few types?
Mutual.
Hmm?
Government bonds,
Government,
Hmm?
corporate,
corporate
Okay.
bonds,
municipal bonds,
Okay.
the treasury bonds, callable bonds, puttable bonds.
Callable bonds, puttable bonds. Okay.
Treasury, zero coupon bonds,
Okay. Zero coupon bonds.
perpetual bonds,
mortgage
Mhm.
deferred bonds,
mortgage bonds,
High
Fine.
yield bonds.
Great. Fine,
municipal
guys.
bonds,
Okay,
anti
good. Fine,
bonds.
ma'am. Fine, enough. So we are also going to discuss few types of bonds here. Okay, I'll try to cover almost every bond that's required for our investment banking and fund accounting as well. The major types of bonds and how these bonds will work. And after this concept, I'll be showing you the uh, some general entries as well. When bond is issuing at discount, what is the general entry? And when we are purchasing the bond, what is the entry? All this will be discussed after this topic. Okay. For the non-common students, I may have to take some accounting classes also for you guys, like about the general entries and accounting concepts and all. So I'll try to take those classes even. Okay.
Okay.
But you guys have to demand from your end. Even our common students also not good with those accounting concepts. So I would ask them to join for those classes even, so that we can at least figure out something for that. Maybe if possible, we'll try to conduct offline sessions because for the accounting classes, I need like a face expressions. Are you guys understanding or not? That's very important for me. That's why I used to teach the basics of accounting. So we'll plan at least like I need 3 days of online sessions, maybe from morning to afternoon or evening like that. If you can plan it accordingly, we will make it happen. Okay.
Okay, Mahesh, sir.
Okay.
Okay, Mahesh.
So we're talking about types of bonds. First, we'll talk about depends on different factors and different characteristics. We have different types. Majorly, there would be two types of bonds. Depends on the interest amount. We have two types of bonds. One is the fixed interest rate, fixed rate bonds, and floating rate bonds. Okay, these are based on the changes of interest. Okay, so already we know fixed rate of bond means the interest remains fixed throughout the tenure of the bond. It won't be changing every month or every year. Suppose while you purchasing the bond, there is an interest amount 3%. Until maturity, the interest amount will be 3% only. There won't be changes in the interest rates. So fixed rate bonds are like very resistant to changes and fluctuations in the market because every time it will be fixed only, right? So there won't be that much fluctuations in the current market price also, unless until there is a huge changes in the big changes in the economy and interest rates, there won't be much fluctuations in the bond prices even in case of fixed rate bonds because the rate the bond interest has been already determined and it is not going to change. You guys can remember this, right? What is fixed rate bond?
Yes. Yes.
Everyone? Yeah. Then floating rate bond. Floating rate means there will be fluctuations in the interest rates. In the previous example, we see, right? Like 5% will be there, 2% will be there. Why there will be fluctuations in the interest rates also, right? In the interest rates also, sir. The interest rates is not going to be determined by one company or one government. For changes in the interest rate, there were several reasons. Maybe from the we consider some reference rates from the other countries. If they change, even our countries will interest rates will also get changed. and depends upon the RBI repo rates and reverse repo rates. Those will also impact our interest rates. And the main important factor, inflations. Based on the inflations also, the interest rates will be a bit different. So by considering all these reasons, the bond interest rate of our bond, suppose if I'm holding the bond of Meta Asper, if it is a floating rate bond, my bond interest will also change. Suppose if interest rates in the market is increasing, as per their reference, there will be consideration of one reference rate. So if the reference rate is increasing, our bond price will also, our bond interest rate will also increase to some extent. So basically, we need to understand that floating rate bond means there will be fluctuations in the interest rates also. As per the current market reference rates, there will be increase in the interest rates of our bond if you are holding floating rate bond. Understood? Everyone?
Yes,
Yes,
Mahesh.
Mahesh.
Yes, Mahesh.
Then
sir.
we have a zero coupon bond, very, very important, zero interest bond or zero coupon bonds. Know what is zero coupon bond? Anyone?
That bond we do not pay regular interest.
Basically, the bonds do not pay any
That-
interest to the bond,
The bond
to the investor.
issued as per discount prices.
So let me give it in a different way. Suppose there is a bond, face value 100 rupees. Okay. There won't be interest rate. Interest rate will be zero. Zero means zero. But on maturity, you will also get it at 100 rupees. You are investing 100 rupees. The face value is 100 rupees. On maturity also, you will get 100 rupees. So what is the benefit? How this zero coupon bonds will work?
We do not pay interest.
Yeah, they are not paying any interest. Any non-commerce students, just try to apply the same formula. Here we spoke about at discount, right? Just try to apply the same. Suppose if they're not paying any interest, on maturity they are paying 100 rupees. Now also we are giving 100 rupees. Will you accept it?
No, the face value is decrease.
No, sir. No, sir.
On maturity, they are not going to pay more than 100 rupees. That we cannot change. But we have a possibilities for the issuing at a discount, issuing at a premium. Issuing premium means more than bond value we have to pay. Discount means less than bond value we have to pay. Now tell me, will you pay less than this bond value or more than bond value?
Less than
Less than
one
mo-
value.
Less than bond value only we have to pay, right? Suppose if I am paying 80 rupees, if I am paying 80 rupees, on realization I'll get 100 rupees. So you'll get a profit of how much?
20 rupees.
120.
20 rupees. This is the concept of zero coupon bonds. So zero coupon bonds will be issued at a discount. Will be issued at discount only.
discount price.
But that will be realized on maturity. Maturity face value. The maturity value and the realized value will be at face value. So the difference between face value and bond investment. We have invested 80 rupees only, right? The purchasing of bond is only 80 rupees at 80 rupees. So difference between the bond purchasing and face value would be the profit to the investors. This is called zero coupon bonds. Zero coupon bonds. Understood?
Yes, Mahesh.
Yes, sir.
And we have one more concept called deep discount bond also. Deep discount bonds. Deep discount bonds also same thing. They won't pay much interest. Sometimes they may pay, they may not pay. But most of the cases, the interest will be very less or it will be zero. That's why we're calling it as a deep discount bond. What is deep discount? While issuing the bond itself, they will issue at a discount. If 100 rupees is the face value of a bond, we will get it at 70 rupees or 80 rupees. That is a very deep discount. Deep discount means for more discounts, we are getting that bond. But on maturity, we will get face value. So that the difference between a invested amount with a discount 80 rupees or 70 rupees minus the face value 100 rupees would be the profit for the investor. Understood?
Okay.
Everyone getting the point?
Yes.
Yeah. This is called
Mahesh.
deep discount bonds. Okay. Now let me explain one thing. Maybe normally we may have some difficulty in writing the journal entries, especially for the zero coupon bonds. Okay. So let me quote. Let me complete these types of bonds and give me a reminder to write a journal entry for the zero coupon bond also. Okay. While I'm explaining about the journal entries, let me write it here. While I'm explaining the journal entries, Give me a reminder for the zero coupon bonds general entry as well. Okay, I'll explain it. Normally, if I'm purchasing a normal bond with a discount with the premium, that won't be a problem to write a general entry, but it may problem to write general entry for the zero coupon bonds. That's the reason we'll talk about it. So then deep discount bonds also we covered. And one more thing, we have inflation linked bonds. Inflation linked bonds. So already the name itself is saying that it's linked to inflation. We know, right? Whenever there is an increasing of inflation, interest rates should also increase. So whenever my bond is linked to inflations, we call it as inflation linked bonds. So the interest rate of inflation linked bonds is generally lower than the fixed rate bonds. The fixed rate bonds will always have a fixed rate, but this inflation rate will always have a lower interest rates because it's linked to inflation, right? If inflation is increasing, interest rate will also increase. If inflation is reducing, interest rates will also reduce. That's the reason the rate of interest would be lower than the fixed rate bonds in case of zero interest rate, inflation linked bonds. Okay, understood?
Yes, Mahesh.
Yeah. Then one more concept, perpetual bonds. So while we are talking about the elements of coupon rate, maturity date, face value, current market price, we are talking about maturity date, right? So there will be maturity date for every bond. If it is a bond, the major characteristic, the main characteristic of a bond is there will be maturity date for bond. But in few cases, there would be a bonds with no maturity date also. There won't be any maturity date. As a holder, as long as you are holding that bond, you will be enjoying the interest throughout the holding period. You can hold it for 10 years, 20 years, then you can sell it to someone else. The bond holder will get interest rate, not purchaser. The bond holder will get an interest rate always. If I'm holding a bond, I'll be getting interest. I can hold it for 10 years. Then I can sell it for someone else. So those persons will also get a bond interest rate until they're holding. These kind of bonds we call it as perpetual bonds. There won't be any maturity date. Bonds without maturity date, they can enjoy, as a bond holder, they can enjoy interest rate as long as they're holding the bond. Understood?
Yes, Mahesh.
This is called perpetual bonds. We have a war bonds. Now, what is war bonds? Normally, in case of world wars, or even in economic wars, governments will issue these bonds. Normally, these war bonds will be issued by the government. It can be financial war or physical war, whatever the kind of wars that are happening. In case of wars only, they will issue these bonds. Normally, the interest it will be a bit higher in case of war bonds. Though it is issuing by the government, the interest rate will be a bit higher. Why they need these bonds? As a bond, whoever issuing the bond, what is the purpose of issuing bond? To get a capital, loan fund, right? To receive the funds only, right, from the public. Why the government needs funds? That too in case of war.
There will be uncertainties during the war.
Yeah, if they want to support a war, it can be financial war, it can be something like a fighting war, whatever it is. There should be funds available from the government side also, right, to support that war. For that reason,
Yes.
they will issue these bonds so that they will raise funds in case of war. For that, they will pay interest. Those bonds we call it as a war bonds. Okay. And we have a serial bonds. Serial bonds. We're talking about maturity period. Some bonds will be a maturity period, and some bonds won't be having a will be having without maturity date also. That's we call it as a perpetual bonds. In the same way, there will be bonds which are going to mature at installment basis. Suppose the face value is 100 rupees. Face value is 100 rupees. So they'll be paying 3% interest per annum. 3% interest per annum. 3% per annum interest rate. So after 2 years, 50% face value will be paid. After 5 years, remaining 50% will be paid. After 5 years, 50% of face value will be paid. And after 10 years, I mean on the 10th year, remaining 50 rupees will be paid to the investor. That is called serial bond. So basically the bonds are maturing over a period of time in installments. That is called serial bond. Understanding? Everyone?
Mahesh, can you
Explain.
Mahesh.
You want me to explain it again?
Yes.
Okay. So
Mahesh,
serial bond.
I have a doubt with the serial bonds. Suppose
Yeah.
face value 100 rupees. First 5 years, after 5 years, they'll paid 50 rupees face value.
Okay.
After 6th year, they'll pay interest for 50 rupees or 100 rupees.
100 rupees.
That depends upon again bond to bond, I think.
Because bit confusion will be there. That is the reason I'm asking for that.
Even I didn't get this question.
Because
I'll
50%
do
is
this.
paid. As per my knowledge, actually, they'll paid for only for face value. Because after 6th year, they'll pay for 50 rupees. Why? Because if they unnecessarily paid the 50 rupees to them, to us, company, there is no use for them. Unnecessarily, they paid extra interest for us another 5 years without money.
But as per my understanding, they won't be paying of interest on the entire face value.
Yeah, I am saying the same. They're not paying for the entire face value.
No. My understanding is maybe they may have to pay for the entire face value because a serial bond.
In that case, company will get lost. No? 6th year onwards, they'll not get the 100%. Suppose they have pulled the 1 lakh rupee amount through bonds. After 5 years, the 50% means 50,000 will be gone to the share bondholders. Company is having only 50,000 rupees. With that 50,000 rupees, they'll not pay for 1 lakh rupee interest. That is my. I have a doubt. Please.
Yes, that would be also the correct. Depends on the availability and the outstanding balance only. The interest payment will be done. Yeah, we can consider in that way. In case of serial bonds, maybe there will be payment of interest only on balance figures. Suppose 3% per annum. First 5 years we will get a 3% on this 100 rupees, and remaining 5 years I'll get an interest for remaining 50 rupees only.
50
Remaining
rupees
50
only.
rupees
Or
only.
else companies
Yes,
will get lost, not necessarily.
Yes, understand. Yeah, that's most fair one. Okay, let me explain it one more time. Salary had a doubt on this. So serial bonds is nothing but the face value. As we're discussing, there will be a maturity period for bonds, and on maturity we have to pay back the face value of a bond. If you're holding the till maturity date, we have to pay this principal amount, I mean the face value amount to the bond holder. So what we are saying is, normally in normal case of bonds, the maturity date and maturity date, the entire face value will be paid to the bond holder in a single time. I mean, at once only they will be paying of maturity. I mean, the face value on maturity date. But in case of serial bonds, the face value will be. Sorry. Okay. So in this case of serial bonds, even the face value will be paid on installment basis. Like for 3 years, some amount of face value will be paid. After 5 years, some amount of face value will be paid. Like that, the principal, the face value will also be paid accordingly. But again, the interest payment will be calculated on the outstanding balance only. Suppose the same example, we have 100 rupees. So for the first 5 years, 50 rupees will be, I mean, the 3% interest will be paid on the total 100 rupees. After paying 50 rupees face value to the investor on 5th year, again for the next 5 years, the interest payment will be done on the remaining face value 50 rupees only. The 3% interest amount will be paid on remaining balance 50 rupees outstanding balance only. That is called serial bonds. In fact, the purpose of having the serial bonds, I think this is the one only, because company, if they're giving without having this installment basis, definitely as a bond holder will have a right to demand this interest until they're holding the bond, right? Maybe after 5 years, company may get a
Yeah.
huge cash. If
Yes,
they want
yes.
to pay off their, if they have to pay off their debt, they have only two choices. Like if they have
Yes.
to convert it into equity. Otherwise, they can follow the serial bond.
Yes.
But again, there would be different scenarios like callable bonds and puttable bonds. So we will discuss those one as well. If any issuer of the company is going with the callable bonds or puttable bonds, even they have an option to pay back before the maturity date also. As issuer of the company, I'll be having a right to pay back the entire amount. I'll be having a right to redeemable bond. I mean, we call it as a redeemable bond as well, callable bonds. So we'll call back my bond and I'll redeem the entire amount even before the maturity date. That is called callable bond. And we have a puttable bond. We'll talk about that one also, don't worry. But for the serial bond, you understood, right? Everyone?
Yes,
Shailaja?
Mahesh.
Okay, great. Then we have climate bonds. Climate bonds. Even these climate bonds also will be issued by the governments only, but not in our regions, but mostly in like Canada, Japan, in those kind of regions, these kind of climate bonds will be more actually, because majorly the insurance companies know if they want to support with a lot of funds during few seasons, because their geographical area is more prone to some natural calamities. Suppose if it is a winter, there will be heavy snowfall, and also there will be tornadoes and everything. So in those cases, the people who took insurance for their houses, they will get a lot of claims from the insurance policy holders. As a client, if they have received insurance company, they have to pay that claim, right, to the insurance policy holder. So in those situations, in those seasons only, they may need a huge cash balances. So what they will do, they will issue these climate bonds in those scenarios. So while issuing bonds, they will quote an interest rate. It may be higher than the normal interest rates also, so that they will collect the required cash, so that they can easily can meet their insurance policies. They have to pay their all claims, right, if they're coming for the insurance claims. So during these specific seasons and specific calamity conditions, the claim policies, the persons who comes for the claims will be more in few climatic conditions. So for that reason, bonds will be issued by the few companies and few governments, even normally in the government's companies. So in those situations, we call it as a climate bonds. Understood, everyone?
Yes, Mahesh.
Yes, Mahesh.
And we have a corporate bonds. It's a straight normal corporate bond only. Like a companies, if companies are issuing this bond, we call it as a corporate bond, not government bond. Corporate means issued by the companies. Public companies are issuing some debt finance instead of taking, rather than taking a loan from the bank, they'll go for the debt finance. Many cases, because the bond market will offer more favorable terms with a lower interest rate, they can get the capital from the public. If they're going for a loan from the bank or financial institutions, they may have to pay a higher rate of interest. But if they're going for the same public finance, public debt finance, they may pay very less interest. For the reason, companies will prefer to go with the corporate bonds also whenever they need capital. And we have a municipal bonds. You know what is municipal bonds? We have a local municipalities, right? State government will have a local municipalities. Madanapalli, we have a municipality. Tirupati is a corporation, not municipality. Like that, there will be municipalities, local municipality governments, right? Bodies.
Yes, sir.
So even those municipalities also will issue the bonds. There will be corporation bonds. Corporations will issue the bond. We have a metro cities we have, right? Metro projects also will issue bonds. But why we have to purchase these municipalities and all municipality and corporation bonds? Because these are also part of government body, government structure also. In addition to that, the major advantage of having these municipal bonds, corporation bonds, metro projects. Suppose in Andhra Pradesh also, while constructing Amaravati, the capital project, there were a few bonds where they are giving some tax saving schemes. You know what is tax saving scheme? Here I'm getting 3 rupees interest, right, on this bond, 100 rupees I'm purchasing. I'll be receiving 3 rupees interest, right? 3 rupees is an income or expense to you as a bond holder.
Income.
Income. So if you are getting an income, you have to pay tax as well to the government. There will be income tax, right? So you have to pay tax.
Yes.
So
Yes, sir.
if you are purchasing this kind of municipal bonds, corporation bonds issued by the government bonds and also issued by specific project, suppose Amaravati project is a, it's like for the development project,
Yes.
capital development project. So definitely there will be a lot of opportunities, and that's why government wants a lot of capital. So they are also giving some bonds. For those bonds also they are given tax exemption. If anyone purchasing the bonds from the Amaravati capital or something, they'll get a lot of exemptions from the government. They don't need to pay taxes again those interest. Even if we get fixed deposits, we have a fixed deposits in our bank, right?
Yes.
On that also you will receive an interest. On that interest also we have to pay tax under the income from other sources. And savings
Yes.
banks also, if you're receiving any interest, on that also you have to pay taxes.
Yes.
Okay, these
Yes,
are called government bonds. So there will be tax advantages as well. In case of municipal bond, corporate bonds, even metro projects also will issue a lot of bonds. Yeah. Understood, everyone?
Yes, Mahesh.
Yes, sir.
And I'll talk about puttable bonds and callable bonds. So puttable bond means there is a fixed maturity period for every bond. Suppose if they are saying for 10 years, before 10 years, I cannot get my capital. I cannot get my face value. If the bond maturity is 100 rupees bond at 3% interest for 10 years. So the bond maturity period is 10 years. As a bond holder, as an investor, if you want to get back my face value, if you want to get back my investment amount, even before maturity date itself, I cannot do in a normal bond. But if it is a puttable bond, if it is a puttable bond, as a bond holder, I can demand, I can collect back my amount. We call it as a retractable bond also. Puttable bond, put bond, or retractable bond. So with this bond, normally as a bond holder will always have a right, or we can say have an option. What is that option? Even before maturity date also, you can surrender the bond and you can redeem the capital. Are you getting the point? Even before the maturity
Yes, bro.
date, I can surrender my bond to the company itself. Company issued 100 rupees bond, they're paying interest. After 3 years, what I'll do? I don't want this bond. I need my cash back. So I'll give back my, I can surrender my bond to the company. I can demand 100 rupees back.
Yes.
That is called puttable bond. But who will have this right? Company or a bond holder?
Bond holder.
Bond holder.
Bond holder.
The holder.
If bond holder having this right to redeem the bond, redeem is nothing but
Bonds.
getting back. We are selling the bond, we are canceling the bond, not cancel. We cannot use the word cancel. We are getting back our capital. That is called redemption, redeemable. So if bond holder having an option to redeem their capital, that is called puttable bond.
Puttable bonds.
Similarly, we
Interest
have an
also
opposite.
will be coming, bro.
Yes, whatever the amount. I mean, suppose you are redeeming the bond between the two interest payments. Between two interest payments. Till that also you will receive an interest. Again, we are going to talk about interest payment rates, dirty price and clean price. There we will discuss about the interest payments, how we will need to calculate the bond price and everything we will discuss. Okay. So in case of callable bonds, here the company will have an option. Normally in case of puttable bond, bond holder have an option to redeem the capital, redeem the bond. Similarly, as a callable bond, company will have this option. What is that option? They can demand back the company, I mean the bond from the bond holder. They can pay back the amount to the investor. Recallable, I mean the callable bond means it's a redeemable bond. We call it the redeemable bond. So the issuer of the company itself may redeem before it reaches to the maturity date. Maturity date is 10 years, but after 5 years, maybe after 2 years itself, they can redeem the bond. They can force the issuer, they can force the bond holder to get back their capital. But this is an option, not a mandatory for every bond. They have an option. Whenever they get a huge capital, if they want to pay back the debt immediately, then they will implement this bond. But while purchasing the bond itself, that should be written in the bond certificate. It's a callable bond, it's a puttable bond, like that. It's not something like after 5 years I can use this, right? No. If you're purchasing this kind of a bond on the initial stage itself, then only you'll be having this right. Getting the point? Everyone?
Yes, bro.
Yes, sir.
Yes, sir. Yes, sir.
And we have a few more bonds like angel bond now. We'll discuss tomorrow because I need to cover a few more the interest reference rates. Whenever if I want to talk about the angel bond and dirty bond like that, junk bond, these are all related to the interest reference rates. And also I may have talking about the rating as well. Bond rating will be there. A plus, A bond, B plus. Like that, there will be bondings. 1 second, I'm getting a call. Sorry guys. So yeah, I have to talk about those concepts as well. So it will take some time. So let me pass this session here. If anyone have any doubts on this bond market, you can ask me, guys. If it wants to be recorded in the session, you can ask me. We will discuss.
We have
Otherwise,
to pay
we'll wrap up.
interest for zero coupon bonds.
Yes, we'll cover about it. That's what I'm saying. Even I had to cover few more types of bonds.
Okay, okay.
I have to cover few more types of bonds and the reference rates of interest. Then I'll cover these concepts. I have to talk about take home conventions. I have to talk about dirty price, clean price, pay down concept. These are all the concepts of bond market. I'll have to discuss all these things. Okay. Shall we wind up here?
Yes.
Yes, Mahesh.
Yes, Mahesh.
Okay.
Yes, sir.
Stopping the recording.